Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures pushing higher this morning with investors optimistic after President Trump says the U.S. has reached a trade deal with the United Kingdom. The president said in a post on Truth Social that today will be an exciting day for the two nations, with the White House promising details in a press conference at 10 a.m. Eastern Time. Meantime, the European Union is planning to impose an additional tariffs on 95 billion euros of U.S. exports if trade talks with the White House fall through. The levies would target cars, planes, and bourbon.
Plus, the Fed says it needs trade clarity from the White House before it's going to rush to cut rates. Powell said the central bank needs more certainty on the direction of trade policy before making a move. And Fed officials voted unanimously to keep the benchmark federal funds rate unchanged. Treasury yields are rising following the wait-and-see messaging.
And tech stocks getting a boost this morning on reports the Trump administration is rolling back Biden-era chip restrictions on artificial intelligence, according to Bloomberg. The move is part of a broader effort to revise global semiconductor trade restrictions that have been drawing strong opposition from major tech companies and foreign governments. However, scrapping the AI diffusion framework won't change the measures targeting China, which Trump recently toughened. President Trump blasted Fed Chair Jerome Powell in a Truth Social post early Thursday, calling the official a, quote, fool after the central bank left rates unchanged at its May meeting. The president has been a vocal advocate of slashing interest rates in the lead up to Wednesday's decision, but Powell noted that the yet unknown impact of tariffs made it difficult for the Fed to act.
The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. In any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Joining us now to discuss, Bill Adams, Comerica Bank's chief economist. Bill, great to speak with you. Wait and see was the phrase of the day, said 12 times on Fed Day. Does the Fed have as much wiggle room and time, in your view, as Powell thinks they do?
Hi, Madison. I think the backward-looking data shows that the economy is in good shape, and so that would tell you that the Fed does have some room to watch to see if they can find out more about what the tariff policy will be and then what its effects will be. The forward-looking data kind of tells a different story. Consumer confidence has been coming down over the last few months, business confidence also softening. At the same time, those surveys are showing both fears of a softer economy, but also fears of higher inflation. And so that points to the job getting tougher for the Fed in the next couple of months.
And so within the next couple of months, we will have the ending of that trade or the tariff pause. And that also brings to the mind and brings to question, how many of these deals does the Fed need to see come through in order for the talk around 100 basis points of cuts, 75 basis points of cuts, to diminish even further?
To my mind, tariffs aren't really paused right now. Tariffs on Chinese imports are over 100%. Tariffs on imports from other countries are 10 percentage points higher than they were on January 19th. And so we're already seeing the impact of tariffs on U.S. imports with the surge in the first quarter and now a sharp drop off since mid-April. I think what is likely to happen going forward is that if tariffs stay at current levels, we'll start to see them passing through to consumer prices in late April and then in May and June. But with this announcement that we might see a trade deal with the UK, that might hint at what a more permanent level of tariffs could be against most trading partners, with the tariffs against China still a big wild card.
So is it good news for the Federal Reserve if and when we have these trade deals?
I think the Fed is trying to balance their dual mandate. They want to see the job market solid. They want to see inflation around 2%. They're not likely to get either wish this year. Even if there are trade deals with major trading partners, it does look like tariff rates are going to be higher after those deals than they were at the start of this year, and potentially substantially higher. And over time, that's going to translate into more inflation, and that's going to be a headwind to the labor market. And I don't think the Fed has tools to prevent that type of an outcome. They can really only balance the trade-off between those two.
Are there non-federal funds rate moves that they could make with the balance sheet, even that would potentially satisfy some of the concerns or quell some of those concerns if we did see within their dual mandate there start to be some signs of a trend that employment is not going to be maximum and prices won't stabilize?
For the Fed to start using the balance sheet rather than just cutting interest rates this year, I think we would have to be in a pretty bad spot. I don't think that's likely. It's a possibility, of course. You know, economists are notoriously bad at predicting severe economic crises, but I don't see a sign of that right now. It looks more like the economy has been softening and decelerating in the last few months and weeks rather than turning into something more adverse. So no, I think it's unlikely that the Fed is going to come to the rescue with a shift out of balance sheet runoff, what they're doing right now, to a renewed expansion of the balance sheet.
Any chance of the Fed hiking rates this year?
Never say never. I think the Fed doesn't want to hike rates. The Fed is concerned that the labor market is softening and doesn't see the job market as a sign, as a source of inflation pressures in the United States. But if we started to get into a situation where wage growth was accelerating because of inflation concerns, despite the unemployment rate rising in a softer economy, then I think the Fed might consider raising rates to control inflation expectations. Hope that doesn't happen. Don't think it's likely, but it is a possibility.
Fingers crossed. Bill, thanks so much. Appreciate the time.
Thanks for having me.
Certainly. Trade news front and center for investors today, with Trump announcing a comprehensive UK deal as the EU ramps up threats if talks fall through with the US. But the deal with the UK today was years in the making, having initially kicked off in 2020. So could this be bad news for investors hoping for more trade deals in the near future? Joining us now, we've got Omar Aguilar, who is the Schwab Asset Management CIO and CEO. Great to have you here with us. So exactly how would you be trading, if at all, on this news, which, as we mentioned, was years in the making, regardless of whether or not some of the characters in those negotiation talks may have changed?
Yes, good morning. We will not specifically going to be trading on these specific news. You know, a big part of the work that we have done with most of the Schwab clients is just continue to work on, you know, how to navigate these periods of short-term volatility. And then understand how you use these as an opportunity to rebalance their portfolio, reposition the portfolio to maintain the diversification. And then in any given day, whether it's, you know, with headline risk or whether it's economic data, usually gives that opportunity to maintain the path towards trying to reassess, you know, where they want to be on the risk spectrum and how to position their portfolio so that they can have a higher likelihood to achieve their investment goals.
Yeah, so to what extent does today give investors a framework for these trade talks going forward? And this particular framework is obviously interesting because, as people I talked to in Washington point out, it took years of talks to get to this place. So if today is a framework for investors, is it a negative one?
Well, the framework of what it's been going on of these, level is we have reached a peak uncertainty, and probably that happened maybe 2 or 3 weeks ago, where everything was up in the air. I think having news on this, obviously understanding the background on how you get to certain agreements, allows to reduce one layer of uncertainty, at least for one country. I think, going forward, we still, don't know. And I think it's still unclear, how the rest of the conversations will go with their other trading partners. And I think to the extent that there is conversations, and I think the market seems to be reacting, and investors seem to be reacting more about, thinking that, to the extent that there is willing, to have conversations and start discussing details about agreements, that is obviously positive for the future. I think the biggest challenge is just timing, and how much of the time goes with the uncertainty still up in the air, and how much of those conversations or those, that progress, could potentially alleviate some of that uncertainty.
It's interesting. We were taking a look at some of the data from the IMF that recently was talking about how the trade war was anticipated to hit the U.S. harder, this in their most recent update here. And as we're thinking about this from the investor's perspective, if you're trying to figure out if a bottom is truly set in, because we still don't have clarity on what the details of these deals will look like, how should investors be evaluating what they see come forward from any of the negotiating countries as we start to get some of the deal talk that gets publicized a little bit more?
Yeah, and I think the biggest concept here, which is something very important, is it is very unlikely and almost with very little probability that anybody could actually find or call it the bottom. I think trying to fish for that bottom so that they feel that the green light is ready to go and they can actually position themselves for a brighter future is something that, will probably not happen. So we continue to work on this idea of, yes, we got to understand the economic implications, both on the hard data and on the soft data, on what these trade conversations and these policies may mean for investors and for markets. But obviously, at the end of the day, is really just looking at how you position your portfolio over time, as opposed to try to say, well, if these 3 or 4 conditions happen, that's exactly what we're going to call the bottom, because I don't think anybody could do that. I think the biggest, pieces here is to understand that, once you start the conversations about changes in trade policy, that already had an impact into the soft data and the consumer sentiment of what positions and what corporations are doing going forward. So there's already a delay in capital expenditures, and that by definition will provide a deceleration of economic growth. So when you put all those pieces together, then that's the part when you say, well, if that is already the base case, let's try to reposition our risk profile to be able to better, seek outcomes in the future.
So do you think that we are in what a lot of people have been trying to figure out, whether this is just a bear market rally or whether we've actually seen a bottoming of the lows and potential sustained move back to the upside?
Well, I think what we have seen is that we have seen a little bit of alleviation of the level of uncertainty. And I think, because the hard data, this is both corporate earnings as well as economic data, continues to be resilient, I think the market seems to be more comfortable thinking that we can navigate more volatility down the road. But I wouldn't necessarily think that we're in the all clear already, because there's still a lot of uncertainty, and we still don't know, to what extent the announcements and the discussions we have had and the news that we have had over the last month or so will have an impact down the road on earnings, and it will have an impact also on just the hard data. So we still haven't seen the impact on the hard data on what we had on trade conversations.
Omar, I want to end in about a final minute left on your thoughts on tech exposure. We've got NVIDIA moving to the upside pre-market after reports that President Trump could repeal Biden's AI chip export curbs, which we're going to talk about further. But I'm curious from your perspective, is there an opportunity for investors to be buying the dips as they come amid this trade war in tech? Or are you more of an advocate for selling any rally to get into a little bit more of an equal weight balance?
Well, we have been advocating clients to just reduce the level of concentration they have in technology. I think the market itself has done a little bit that already. I think the initial sell-off that we had, even regardless of anything that had to do with trade talks, ended up having that effect of reducing that concentration. I think what we encourage, people to say is look at the fundamentals of these companies. Their companies continue to generate free cash flow, continue to have a big exposure, not only domestically, but international. And in many cases, it's very hard to replicate what they do, even in other countries. So to the extent that you can understand the scope of what the companies do, it is really more a case by case on what companies can actually produce down the road, as opposed to just, trying to just get a sector all together. But we do encourage clients to continue to reduce their overall concentration in one single sector. I think, having that diversified, component, especially going international, is probably like a good idea.
All right, Omar, really great overview there of some actionable investment advice. Thank you so much. Appreciate it. Coming up here on Morning Brief this morning, we're going to count you down to the opening bell on Wall Street. Plus, NVIDIA shares boosted as the U.S. looks to overall global chip curbs. And looking at Bitcoin nearing the $100,000 mark, we're going to break down investor appetite for risk and much more ahead on Morning Brief. Occidental Petroleum topping first quarter profit expectations boosted by strong output and natural gas prices. Meantime, ConocoPhillips also topping first quarter earnings estimates as both oil and gas producers announce cuts to full year capital expenditures. Joining us now, we've got Fernando Valley. He is the Hedgeye Risk Management Energy Analyst. Thank you for joining us this morning, Fernando. Talk to me about the through line between these two names. It seems both of them could be beneficiaries of commodity prices right now.
Yeah, absolutely. I think the big difference is Conoco's overall exposure is more diversified. They have more assets outside of the U.S., more low decline assets like oil sands and LNG, although they've increased their exposure to U.S. shale with their acquisition of Marathon Oil. This is the first full quarter that acquisition was under control for Conoco. Whereas Oxy, especially after the Anadarko deal, has become much more of a U.S. shale producer. The big difference to us, though, is not just that higher corporate decline for Oxy, but it's also the net debt. The net debt for Oxy is significantly higher. And we are still in a scenario where we think oil prices are going to face headwinds. And as you mentioned, they did really well in the first quarter because natural gas prices went higher. But when we look forward, that's come down significantly in the second quarter. Seasonality is hitting. And so we think that it's really time for some of these oil companies, not just to take down CapEx as they've done, but to really focus on debt reduction.
You know, something that's also interesting from Occidental's perspective, Fernando, they essentially slimmed their midpoint for CapEx in 2025. I believe they brought that down by about $200 million. And then additionally, some of the guidance on the domestic operating costs, that came down $150 million. I mean, what is the significance of that, considering how these oil companies and how the broader industry are prioritizing those capital expenditure efforts to really unlock the next legs of their business for 15, 10, maybe even 20 years?
Yeah, it's a good question, and one where we have less clarity on how that will factor in 15, 20 years, because as you mentioned, $200 million cut for Oxy, while Diamondback, which is about half their size, is cut by $400 million. So yes, they've cut some, but some of this could also be front loading of CapEx. You have more CapEx in the beginning of the year. With WTI still under 60, they should probably have been cutting even sharper. Wow. You'd also consider that part of the reason it didn't decrease as much is because tariffs are having a huge impact on steel and the casing that goes into the wells. So that's increased about 15 to 20%, depending on the type of well that you're drilling, which has a significant impact. Casing is about 35% of the cost of the well. So it's very significant on the overall cost. So they've cut down by $200 million, but the activity is probably down even sharper because of those tariffs impacts.
And Fernando, I'm wondering how you're thinking about Warren Buffett's retirement and the potential impact that could have on a company like Occidental. Berkshire having a 28% stake in the company. Is that a bullish or bearish signal for Oxy?
I think it's probably slightly bullish. His successor ran Berkshire Energy, so he's very intimate with energy, not just oil and gas, but energy more broadly. I'll say that the Occidental deal that Berkshire got was very attractive. They got not just preferreds, but warrants as well, because Oxy was desperate to close the Anadarko deal, and they needed to do so without a shareholders vote. And so they gave them a great deal at the time, which again goes into that capital discipline. It's probably why we'd prefer Conoco over Oxy. They've proven themselves to be the discipline player. We call them the poster child of capital discipline because of not just their acquisitions, but also how slow they've been to develop some of their shale assets, a lot more pragmatic and a lot more focused on the overall returns.
Fernando, great to have you here with us. Thanks so much for taking the time this morning. Now time for some of today's trending tickers. We're watching NVIDIA, AppLovin, and Molson Coors. First up, The Commerce Department confirming the U.S. will not enforce global AI chip diffusion rules set to go into effect May 15th. Chip stocks, including NVIDIA, rising on the news, an NVIDIA spokesperson saying the company welcomes the change. This is separate from curbs on China, which the Trump administration has maintained. According to Bloomberg, the administration plans to pursue individual trade deals with nations like Saudi Arabia and UAE. Shares of NVIDIA, as well as some of the other semis here that would be most impacted, you're seeing them reacting, moving positive here, at least pre-market right now.
Yeah, what's really interesting about this is that it gives us some insight into the tools in the toolkit from the Trump administration. Are they going to go after any allies that they could be selling chips to, like the UAE, for example, that could then turn around and sell those chips to China via that second-party toolkit there? So that's going to be interesting to watch. Citi this morning saying this is not all good news, in part because of what I just laid out, but also because it could be replaced with global licensing agreements that could end up being stricter than the current export controls. Having said that, given that NVIDIA had previously criticized this rule from the Biden administration, we are seeing those shares up over 1.5% this morning. Next up, shares of AppLovin popping after sales rose in the latest quarter and news that the company will sell its mobile gaming unit. AppLovin's first quarter sales jumped 40% year over year to nearly $1.5 billion. The company will sell its gaming deal developer Triple Dot in a $400 million deal and a 20% stake in Triple Dot as well. Just a huge move to the upside here in the stock. It is up nearly 17%. Taking a look at the stock performance year to date, you're getting a very different picture. It's a stock that's been down about 11% year to date here, and we're seeing a little bit of a recovery. It hit its peak back on Valentine's Day in early February here, and it has gone down significantly since that date. So it's going to be interesting to see if they can recover some of those losses.
Yeah, a few things in the outlook that I'm looking at here, specifically what they're looking for in advertising revenue here, projecting between $1 billion and $1.215 billion. And then additionally, the company long-term is anticipating this growth rate of about 20 to 30% here, and really anticipating that some of the machine learning and expansion in the advertising capabilities that they offer and over the web, that will ultimately kind of bolster some of these guidance. The company's CEO, in terms of some of the executive commentary that we do have here as well, coming out of the earnings, the CEO, Adam Frugi, saying that we think we've got the best performance advertising AI model the world has ever seen today. The CFO essentially kind of layering in, saying the adjusted EBITDA per employee in their advertising business has risen to approximately $4 million annually. So that is significant here. But I think a lot of the Q&A was really focused in on what is going to take place across some of the apps that they're also kind of intertwined with, and also the bid proposal for TikTok here, which is a major deal surrounding AppLovin's name right now. So we'll see how investors continue to monitor this one, but shares up by about 17% here this morning. Finally, beverage company Molson Coors lowering its outlook for the full year. Shares slid after the parent of Miller's and Coors Beers announced it now expects a year-over-year decrease in sales, saying consumers are pulling back and trade policy has put pressure on its business. Shares right now are down by about 5%. The business of brew getting hit by a little bit of trade uncertainty or fisticuffs right now.
Yeah, cutting their guidance to single-digit growth for both sales and earnings, talking about that weaker macro environment here, that weighing on the shares here. You can see this on your screen, but also the CEO stepping down by the end of this year. Another potential headwind for investors. Famously, Amy Wu Silverman telling us that right now investors are investing in management teams, not companies, because of the uncertainty that Molson Coors pointed out here. And it's interesting to also hear them say less beer is being drunk due to concerns about tariffs in the economy, seeing that potential consumer pullback narrative here as well.
Yeah, there's also a larger kind of generational shift that we've continued to talk with many of these CEOs around, whether that be Molson Coors, whether that be Constellation Brands. Bill Newlands takes the time to join us pretty much quarterly here. And one of the things that he always acknowledges is that, yeah, millennials, Gen Z have less of a propensity compared to baby boomers, compared to even Gen X to drink as much or consume as much beer, and so that's changing their business models and how they're coming across new products that they have to make sure that they're bringing to market as well. So that is a continuation in trend that we're tracking, at least right now.
Yeah, absolutely. I'll lastly just quickly mention that when the CEO of AB InBev was speaking with us last, they talked about how immigrant communities in particular are not gathering as frequently in outdoor spaces given some of the policies of the administration, and that they're seeing that weighing on sales as well. So just a slew of factors impacting some of these names. You can scan that QR code on your screen to track the best and worst performing stocks of the session. All your markets action ahead. Stay tuned. You're watching Morning Brief.
There you're taking a live look at the opening bell at the New York Stock Exchange and at the NASDAQ. Great bell ringers on both sides, funfetti on one side, and you see it there for the Celiac Disease Foundation in Midtown Manhattan and Times Square at the NASDAQ, and Aspen ringing the opening bell at the NYSE. All right, let's take a look at how we begin today's trading session here on this Friday's Eve, this Thursday. Taking a look at the Dow, it's higher by about 0.5% to begin today's trading activity just after the opening cross. NASDAQ Composite, you're seeing that move higher by about 1%. S&P 500, that's up by about 0.7%. Let's dive a little deeper into the heat maps here just to see what's transpiring. Out of the gate here this morning, you've got more leaders than laggards here on the sector front. 11 S&P 500 sectors. We've got them loaded up here for you on the screen. Pulling up the caboose, you've got healthcare right now. That's fading by about 0.7% here. And then additionally, leading the pack, you've got consumer discretionary. Let's populate this so you could see the trailing 5 sessions here that we've been tracking. And over the past 5 days, it's been interesting to watch. Overall, though, we are still net higher by about 1.5% for consumer discretionary. Technology has also been in the leading category out the gate here this morning of sectors. You're seeing that higher by about 1%. And over the course of this week, it's largely held on to gains right now. In aggregate, up over 2.3% over those 5 sessions here. Taking a look deeper at those tech names for the mega cap tech stocks, you're seeing some pretty sizable gains out here of the gate. Microsoft, Amazon, those are up more than 1%. Alphabet, Google, whatever you're calling them, call them up higher by 1% as well, and Meta as well. Also adding on about 1.7% here to begin today's trading activity. A few spots of red here, so we'll put this on an equal view. It looks like you count those on 2 hands almost if you have some extra fingers, but ultimately at the end of the day, it's Fortinet that's bringing up the caboose there. That's down by about 10%. It was actually one of our leaders yesterday that we were tracking here, and so we'll continue to track that as we move on throughout the rest of today's trading session. And let's just take a brief look at the Dow 30, those 30 components, Dow Jones Industrial Average here on the day. And looks like you have more leaders than laggards, led by the big ears over at Disney and right now, Amgen. That is in the back of the pack. That's down by about 3.4% to begin today's trading activity. For a deeper dive on today's tape early in the trade, let's toss things on over to Jared Blickery.
Thank you, Brad. I want to go back to the indices. Stocks are set for their second up day in a row. So if you're keeping score, we had 9 days up, 2 days down. Now it might be 2 days up again. I'm going to focus on the NASDAQ 100 here, and I just want to show you a year-to-date. A lot of the index charts look pretty similar, but I think the NASDAQ 100 is the best example of this. What we have setting up is a potential inverse head and shoulders, and it's a little bit too early to call this. We need to come down a little bit and then punch through the neckline and then kind of race higher. We might have a shot at those record highs if that happens. Or on the other hand, we could sell off from here and we could make a run at the lows and then have to see if we can form a double bottom. So there's a bullish case, there's a bearish case, and well, what happens remains to be seen here. Want to look at the VIX too, because the VIX has been consolidating over the last 5 days, kind of between the 20 or low 20s and mid 20s here. And you can see that evidently pretty clearly in this chart. There's the upper side in the 25 level, and then to the downside about 22. We are now at the lower end of the range. But if I put a 1 month chart in, you can see we have still come down quite a bit. Should add that small caps leading in early trading, but I want to move on to the sector action that Brad was just looking at. Something stood out in the early trading. That was the Mag 7 stocks were leading, the Mag 7 sectors were leading. That would be consumer discretionary, tech, and communication services. Have a little bit of a leadership shift here. Energy is now in the forefront. That is up 1.37%. We'll take a look at crude oil in a minute. But first, I want to go to the NASDAQ 100 and check out the leaders there. Tesla has taken the lead from Alphabet. Alphabet was leading pre-market among the Mag 7. Tesla is now leading. You can see that dark green rectangle up 3.29% and changing by the second here. AMD also up 3% in the lower end of your screen, announcing earnings earlier this week. And of course, we're coming off that big Fed day. But one thing that typically doesn't move on the Fed announcement is crude oil. And that's what I'm going to look at right now. It is leading commodities up 1.81%. If we look at the 5-day, it has been kind of consolidating too. Has not been able to punch through $60. And as I've been pointing out, I lost the chart. As I've been pointing out, it's basically at a 4-year low. And so that's something we want to monitor, in as much as crude oil is kind of a barometer for global risk, at least manufacturing demand. So I'm going to close on Bitcoin here. I think I was watching the Fed reaction at a bunch of markets yesterday, and I think Bitcoin was one of the leaders. And this is a 6-year chart. Want to dial it down to a year to date. Hasn't been able to quite punch through 100,000. That's one of those big levels. We saw it hit 107,000 earlier in the year. That was a record high. But we are now well off of these lows, and we've seen Bitcoin lead before, and maybe it's leading risk markets higher right now. Send it back to you, Maddie.
All right, Jared, thank you so much, as always. Appreciate it. It's time now for today's strategy session. U.S. stocks opening in the green this morning after snapping 3 days of losses. But what is the near-term trade for investors as stocks trade within a narrow range? Joining us now, Kenny Polcari, Slatestone Wealth Chief Market Strategist and host of the Trader Talk podcast on Yahoo Finance and friend of the show. Kenny, thank you for being here with us, as always. So obviously there's a lot of enthusiasm this morning, both ahead of potential trade talks between the U.S. and the U.K., but also on these potential changes to chip curbs. What do investors do with the tech trade now? Continue to buy any tech names, all of them?
Well, you got to take a look at the sector, but certainly any of the names that are in tech, and most of them are in tech. But if you're talking about Nvidia, Palantir, AMD, any of these names that sit kind of at the nexus of what's going on in tech, that have been really dislocated over the past month because they'd gotten beaten up. Are names that if this goes through, this sanction really goes through the way they're talking about it, then I think they're all buys. But certainly, the favorite names, right? Palantir for sure, Nvidia for sure, AMD.
What do you think the break-even point for some traders out there is right now? Because that seems to be where a lot of the thinking comes back into play off of these rallies, that you're selling the rally just to break even instead of buying further in.
Well, okay, because you're talking about a trader. So a trader is someone who's in and out, he's in and out. So if they bought it down, 300 points, then they're going to sell it up 250 or 300 points. So they're going to kind of get in the way. But if you're a long-term investor and you bought it lower, you're not looking to flip it out, you're looking to hold it. So the trader types are always the one that, kind of create all the noise around it because they're in and out, they're in and out. So yeah, if they bought it lower, they're absolutely going to be selling it as we test the trend line, because we're just about to kiss the trend line here on the S&P, and I think that's going to actually keep a lid on it. I think we're going to have a tough time getting through the trend line until we get more clarity and until we get more deals.
Well, we're about to get a deal announcement at 10 a.m. today.
Right.
But that deal, it took a long time to get there.
Right, and we don't know yet what the particulars, and what we do know so far is that it's on cars and steel, I think is what I read this morning, unless it's changed again, and potentially some of the digital stuff, potentially some of the tech stuff. So let's wait and see what that deal looks like. Let's wait and see if that ends up becoming like a blueprint for other trade agreements, not necessarily with cars and steel, but just kind of the way they brought it together, right?
But it sounds like it doesn't make you much more optimistic in the short term.
No, it makes me optimistic, but it doesn't make me a raging bull where I'm saying go out and buy everything, because I think what's going to happen is the market's had this nice rally right up to the trend line. I think it's going to struggle at the trend line for a little bit, which means no reason to be anxious and run right out there and buy everything. Relax. Let's just see how it goes. If you're a long-term investor, you've enjoyed this move down, you took advantage of the move lower, let this run for you. On days like today with the markets up like this, as a long-term wealth advisor, I'm not buying. I'm not chasing. Because we own stock, we bought stock lower, so we're going to sit and let it happen.
What's more important, for us to see a trade deal come forward from a huge trading partner, a large country by GDP, or some of these smaller ones, perhaps in a packaged fashion?
Listen, it's a great question. You always want to see a deal come together from a large trading partner for sure, because it's a large trading partner. Right. But if you can bring 4 or 5 smaller countries to the table with deals, like I said last week, we need a couple of base hits. You don't necessarily even need a home run. You need a base hit or two to just get it going. Because once it gets going, then I think the others really fall in line, because they're going to see all the excitement. They're going to see these other countries making these deals, and they're going to want to jump on the bandwagon. They don't want to be left behind. mind, other than China's going to be a little bit of an issue. But that's because there's so much, we did it to ourselves, all this reliance on China over the years, right? We did it to ourselves. So that one might take a little bit longer. But look, I think China is going to be anxious to come to the table.
Where does the Fed stand in all of this, in your view?
So the Fed didn't do anything that I didn't expect, right? I'm in the camp that we're getting no rate cuts this year. Let's just put that out on the table, right? Unless the hard economic data really falls off the edge, I'm in the camp that the Fed stays put. I think he made that very clear yesterday. While he walked the line, he wasn't more hawkish or dovish. He walked the line. But I think the Fed stays put. And I don't think there's any reason at all. Look, they keep saying rates are restrictive. The hard data continues to be robust. So what's restrictive about these rates, right? And so I don't see it. And by the way, it's well within the normal trading range, right? Between 4 and 6% is very normal. So this idea, I think Goldman's got 3 rate cuts by the end of the year, which takes us into the low 3s or mid 3s, which I don't think we need at the moment. So I'm in a camp that I think Jay Powell does exactly what he says. He's going to sit tight.
Yeah, he's going to wait and see, as he said 12 times
Yes,
yesterday. Kenny, thank you so much. Appreciate you joining us, as always. Thank you.
you.
And reminder for our viewers, you can find new episodes of Trader Talk every Wednesday wherever you listen to your podcast to get more of this actionable investment advice from Kenny Polcari. It's time now for Chart of the Day. Let's send it over to Brad Smith for a look at Bitcoin nearing the $100,000 mark. Hey, Brad.
Yeah, longtime viewer of Chart of the Day, first-time charter here. So let's take a look first at that key level, which is 100,000. And yeah, we were able to break through that earlier on in the year. A lot of the fervor coming off of the election. And then, as you heard, some of the announcements from the incoming administration. And then once President Trump was inaugurated and retook office, it was about, okay, will these things be followed through on? What will this Bitcoin strategic reserve look like? What is it in activity? Are they purchasers of Bitcoin? And how does that add to the balance sheet as well? All of these things considered, we've been waiting for more clarity on some of those at the same time that we've been seeing this de-risking of assets that's taken place both in equity markets and in the crypto landscape as well. And so one of the things that I was tracking here was specifically, as we're trying to get back to that 100,000 mark, is this fear and greed index. And this comes from CoinMarketCap, and it essentially kind of looks at the price momentum, volatility, derivatives market, and market composition, and assesses all of this data to really get a sense of where we are in this fear and greed mindset here and how that is actually correlating with where the price is. And what's interesting is, we typically, when we're looking at a greed or fear level and reading right now as we are in this kind of mid to high 50s level, you don't typically see the price of Bitcoin up near $100,000 or in an uptrend. And so this is one of the first times that we've actually been, this is one of the first times that we've actually been in this downtrend and then ultimately trying to break out of that downtrend and seeing fear and greed still sitting within what would normally be a healthy level for that fear and greed index. Because if you're taking a look at this multicolored line, yeah, we've seen that actually peak above 80 at some points, get into the 90s when we were still in this range of 60 to 80K. And so all this considered, this is perhaps one of the first times that we'll see Bitcoin top or get to 100,000 without needing to be at an excessive fear or greed index level. And that is something that I think that's worth watching going forward from here, and whether or not the other altcoins see any type of flows into that space as well here, Maddie.
Brad, thank you so much. Sticking with crypto, let's look at shares of Coinbase up over 4% after the market opened, higher after the company said it's acquiring Deribit, the world's largest exchange for Bitcoin and Ether options, for $2.9 billion. As the biggest U.S. crypto exchange makes a push into the derivatives market. The purchase marking one of the most significant acquisitions in the industry's history, and coming as Donald Trump's return to the White House sparks a wave of deal-making among crypto companies. President Trump has appointed digital asset advocates to key government positions and enacted policies benefiting the industry, such as the creation of a Bitcoin reserve, while also pursuing his own crypto businesses in what Democratic lawmakers complain is a major conflict of interest. Coinbase announced the purchase in posts on the X social media platform and blog, calling it a major step in our global expansion strategy. The deal will be comprised of $700 million in cash and 11 million shares of Coinbase stock, subject to customary purchase price adjustments. The company said much. Here's what the company had to say. Warner Brothers Discovery shares moving higher despite the media giant missing revenue expectations in its fiscal first quarter. Seeing some headlines that explain the move. According to CNBC, Warner Bros. Discovery is moving towards splitting the company here. The timing is unclear. It would take time, but also the company did break out all of the individual businesses in its earnings release, so potentially that being a tease of a potential split. The split would look like linear cable on one side, the other being studio and Max. In terms of the company's results here, revenue for distribution, advertising, and content segments declined across the board on an annual basis. The company attributing a 25% drop in content revenue to weaker box office performance and a lack of game releases during the 3-month period as well. Warner Brothers ending the quarter with more than 122 million streaming subscribers, a 5.3 million increase from the previous quarter. But those gains were offset by a steady decline in paid TV subscribers as viewers increasingly turning away from traditional cable models. And as I just mentioned, CNBC reporting this morning that the company is moving toward that split. According to the reports, the split would divide its linear cable business from the company's studio and streaming divisions. Brad?
Yeah, you hear an announcement like that and how the company is thinking through it, and you immediately go to a shareholder release or any type of letter and look for the words cost discipline. And that's exactly what you got here within the shareholder release. The challenging and uncertain environment they remark it as, they remain focused on optimizing global linear networks performance, maximizing cash flows through cost discipline and prudent content investment. As part of that strategy, they went on to say whether it's offering paid TV subscribers authenticated access to Max Ad Light tier or providing incremental building and packaging flexibility, trying to work with distributors they're doing right now to enhance the value of pay TV subscriptions, which speaks exactly to the kind of separation and how this division could essentially work here based on what the company has also talked about in the past. You'll remember in December of 2024, they essentially had announced that they were going to be looking for optionality to pursue further value creation opportunities for these two divisions, global linear networks and streaming and studios here. So it's just a matter of exactly how they're investing or continuing to invest into what has been the behemoth, the juggernaut that the linear business has been. However, how much of that and that effort is also now moving over to the streaming side as well, and how the company is thinking about it more holistically on aggregate as well.
Absolutely.
We've got all your markets action ahead. Stay tuned. You're watching the Morning Brief. U.S. stock futures pushing higher this morning after the U.S. announced a first trade deal here. We are moments away from a big announcement on the tariff front as President Trump will announce a trade deal with the U.K. The first deal amid a larger trade war. Trump posting on Truth Social this morning that the agreement is, quote, full and comprehensive. He also says many other deals in serious stages of negotiation will follow. Here with what we can expect is Yahoo Finance Washington correspondent Ben Werschel. Ben, we know that this deal has been years in the making, though, versus others where negotiations are essentially just ratcheting up.
For sure, yeah. We're going to get full details shortly on this U.S.-UK deal when Trump announces in the Oval Office. And UK Prime Minister Keir Starmer is also expected to announce it at about the same time as well. What this looks to be is a pretty targeted deal that's been evolving, especially since Starmer was here in Washington in February for what was a surprisingly cordial meeting. What we're expecting is essentially a trade here where the UK gets a lowering of some sector-specific tariffs. Most in focus at the moment are steel and automobiles. And then in return, what Washington gets is concessions on digital service taxes. This has been an issue for Trump since he began that hits U.S. tech companies, as well as the opening of UK markets in some form to things like automobiles and agriculture. Watch for that agriculture piece to be in big focus in the next hour with Trump. Brooke Rollins, the agricultural secretary, has already talked about this as a great deal for U.S. farmers and ranchers, and she's announced she's going to be headed to the UK this weekend for more on that. So that's a big part of this. What's apparently not in the offing is any change to the 10% baseline tariffs. These are the tariffs that Trump has imposed on nearly every country in the world. It's not totally expected. A CNN report this morning suggests that's not going to be in the deal or any change there. That's not totally expected. Trump has described this as a floor to a certain extent, but that appears to be in place. So overall, a lot of details to be seen. All of these things I've outlined could have a lot more to come, but it does provide a little evidence of where Trump has give and what doesn't, if this holds.
It certainly does. And Ben, we're going to get to talk with you more about it later on, so I appreciate your reporting this morning. Thank you so much.
Sure thing.
That's going to do it for the morning brief. Joining me in the next hour for more analysis on Callis and then Brad for Wealth after that. Stick around.